There is a single, solitary rule that separates the investors who build lasting fortunes from those who inevitably end up at zero. It is not a complex formula. It is not a secret stock tip whispered in a boardroom. It is a brutally simple principle, a line in the sand that, once crossed, changes the entire nature of the game you are playing. It is the one rule that, if followed, guarantees you will never face a game-over screen in the unforgiving arena of the stock market. Warren Buffett, a man who has compounded wealth for nearly a century, has articulated this rule in many ways, but the essence is this: never ever borrow money to buy stocks. He has stated, with the cold clarity of a man who has witnessed countless financial tragedies, that there is simply no upside in the world that can justify the risk of being wiped out completely. He once said, "My partner Charlie and I have seen great wealth built by people who were not particularly smart, but who were rational, and we have seen very smart people go broke." It is a sin to borrow money on a stock market speculation. This isn't just advice for beginners. This is a law of financial physics that applies to everyone, from the retail investor opening their first brokerage account to the hedge fund titan managing billions. Because the market, in its infinite and often cruel wisdom, does not care how intelligent you are. It does not care how right you have been in the past. It only cares if you can survive its most violent storms. And borrowing money, using what Wall Street calls leverage or margin, is like setting sail into a hurricane on a magnificent yacht, but with a single, fatal hole drilled through the hull. For a while, the ride might be exhilarating, the speed breathtaking. But when the storm hits, the outcome is not in doubt. You will sink. And unlike a simple mistake made with your own capital, where you can live to invest another day, this mistake is final. It takes you out of the game permanently. Today, we are not just going to talk about this rule. We are going to dissect it. We will explore the absolute finality of the ruin it prevents. We will unravel the psychological fallacies that tempt even the brightest minds to believe they have found a sure thing that justifies the risk. We will walk through the mechanical and emotional horror of a margin call the moment the market wrests control from your hands and forces your ruin upon you. We will then pivot to the immense, almost magical power that is unlocked simply by staying in the game, a power only available to those who refuse to play with fire. And finally, we will lay out the blueprint for building your own unbreakable financial fortress, a structure designed not for quick gains, but for permanent wealth and true financial freedom. This is not about being timid, it is about being invincible. It is about understanding that the first and most important step in the art of winning is to ensure that you can never, ever lose. The greatest danger in finance is not stupidity, it is the illusion of intelligence. It is the hubris that comes from a string of successes, the feeling that you have finally cracked the code and are no longer subject to the same gravitational forces as everyone else. This is the fertile ground where the seeds of ruin are sown, and the tool used to harvest that ruin is almost always leverage. The story that best illustrates this terrifying truth is not about a novice gambler, but about a room full of certified geniuses, men who possessed arguably the highest collective IQ ever assembled to attack the financial markets. It is the story of long-term capital management, or LTCM, a cautionary tale so profound that Warren Buffett himself would be called in to help clean up the wreckage. In 1994, the fund was launched to a chorus of acclaim. Its founding partners were a who's who of financial royalty. John Meriwether, the legendary bond trader from Salomon Brothers, was at the helm. Alongside him were two Nobel Prize-winning economists, Myron Scholes and Robert C. Merton, the very architects of the Black-Scholes model, the foundational formula for pricing financial options. These were not just smart people, they were the men who wrote the textbooks. They believed they had developed a new paradigm for risk management. Their strategy was complex, involving what are known as convergence trades. In simple terms, they would find two similar securities, say two different types of government bonds, that had historically traded at a very close price, but which had temporarily diverged. They would bet that this small price gap would eventually close or converge. The problem was that these gaps were minuscule, often just a few pennies. To make any real money, they had to use an astronomical amount of leverage. For every $1 of their own capital, they were borrowing and betting with more than $25. And as the fund grew and took on more complex derivatives, its true leverage ratio rocketed past 100 to 1. For a time, it worked like a charm. The geniuses were right. The tiny gaps closed, and with their massive leverage, LTCM generated returns that were the envy of Wall Street, posting annual gains of over 40% in its early years. They managed over $100 billion in assets, with a capital base of less than $5 billion. They were the smartest guys in the room, and their complex algorithms and Nobel laureate-stamped risk management models told them that the probability of them facing a catastrophic loss was infinitesimally small, a statistical impossibility that might occur once in the entire history of the universe. They had built a system that, according to their math, could not fail. But the market has a way of producing events that lie outside the neat bell curves of academic models. In August of 1998, a seemingly unrelated event happened on the other side of the world. Russia defaulted on its government debt. This was the black swan event, the statistical impossibility. A panic swept through global markets. Instead of seeking safety in the usual places, investors fled from everything that seemed even remotely risky, a phenomenon known as a flight to quality. The carefully calculated price gaps that LTCM was betting on did not converge. They blew out to unprecedented widths. Their models, based on historical data, broke down completely because they were witnessing a market environment that had never existed before. As their positions went against them, the losses, magnified by their gargantuan leverage, were apocalyptic. In a single month, August 1998, the fund lost $1.85 billion, a staggering 44% of its capital. The one-way gate had slammed shut behind them. Their lenders, the biggest banks on Wall Street, began to panic. They demanded more collateral, initiating margin calls that LTCM could not meet. The fund was forced to liquidate its positions into a market that was already in a state of freefall, causing the prices of the assets they were selling to plummet even further, which in turn triggered even more margin calls. It was a death spiral. By the end of September, the fund had lost over $4.6 billion and was on the brink of a collapse so massive that the Federal Reserve feared it could trigger a chain reaction and take down the entire global financial system. The Federal Reserve of New York had to orchestrate a massive $3.6 billion bailout, bringing together the heads of every major Wall Street bank into a single room to save their own skins. Warren Buffett was part of a consortium that offered to buy out the entire portfolio for a pittance, a deal that was ultimately rejected but highlighted just how dire the situation had become. The geniuses, the Nobel laureates, the titans of finance were wiped out, not just humbled, but completely and utterly erased from the game. Their sin was not being wrong. Everyone is wrong in the market from time to time. Their sin was making a bet that they couldn't afford to be wrong on. They had walked through a one-way gate. This catastrophic failure of long-term capital management wasn't just a failure of mathematical models, it was a profound failure of human psychology. The core mental flaw that brought these brilliant men to their knees is a potent combination of the Dunning-Kruger effect and a deep-seated overconfidence bias. The Dunning-Kruger effect is a cognitive bias wherein people with low ability at a task overestimate their ability. But there's a flip side that's even more dangerous. Highly competent individuals can sometimes fail to recognize the limits of their own knowledge. The partners at LTCM were not just competent, they were pioneers. They had created the very tools used to measure risk, and this mastery created a crippling blind spot. They believed their understanding was so complete that they could effectively eliminate risk rather than simply manage it. This bled directly into overconfidence bias, the tendency for people to be more confident in their own abilities than is objectively reasonable. After years of stunning success, their confidence metastasized into a certainty. They stopped questioning their own assumptions. Their models, which were just representations of past reality, became, in their minds, the infallible predictors of future reality. On a cerebral level, this is a dopamine-fueled feedback loop. Each successful leveraged trade releases a hit of dopamine, the neurotransmitter associated with reward and pleasure. This reinforces the behavior, making it feel not just profitable, but correct. The brain starts to equate leverage with genius. You are not just making money. You are proving you are smarter than everyone else. This feeling is incredibly addictive. It quiets the nagging voice of prudence, the part of your brain in the prefrontal cortex responsible for executive decision-making and long-term consequence analysis. Instead, the more primitive reward-seeking parts of the brain take over, demanding bigger bets and more leverage to get an even bigger dopamine hit. The geniuses at LTCM were not immune to this. They were perhaps even more susceptible. Their intelligence provided the ultimate rationalization for their addiction. They weren't gambling. They were executing statistically validated arbitrage strategies. This is the danger. The smarter you are, the more sophisticated your justifications for foolish behavior can become. To protect yourself from this insidious form of self-destruction, you need a mental model that acts as a circuit breaker, a hard-coded rule that cannot be overridden by emotion or ego. The most powerful one in this context is the one-way gate framework. Imagine every major decision in your life, especially financial ones, as a door. Some doors are two-way gates. You can walk through them, and if you don't like what's on the other side, you can turn around and walk back out. Buying a stock with your own cash is a two-way gate. If the company's prospects sour, or you simply change your mind, you can sell it. You might take a loss, but you walk back through the gate with the remaining capital, free to make another decision. The experience is painful, but not fatal. You stay in the game. Borrowing money to invest, however, is a one-way gate. It is a door that, once you step through, may lock permanently behind you. The potential for a game-over scenario, a state of total ruin from which there is no recovery, transforms it into a fundamentally different category of risk. The application of this mental model is a simple but non-negotiable checklist to be used before any significant financial commitment. Step 1. Identify the decision. Be specific. I am considering taking a $20,000 margin loan to buy more of XYZ tech stock. Step 2. Ask the critical question. Does this decision create any possible scenario, however remote, that could result in my total financial ruin? Be brutally honest. Don't think about the probability. Think about the possibility. Could a sudden market crash, a regulatory change, an accounting scandal at the company, or a personal emergency that requires you to sell at the worst time, when combined with this leverage, wipe you out? Step 3. If the answer is yes, the decision is forbidden. It's not a matter of weighing the pros and cons. The potential for a spectacular upside is irrelevant. The allure of doubling your gains is a siren song. The presence of that one-way gate to ruin means the decision is off the table, period. This is not about being risk-averse. It is about being ruin-averse. Buffett is famous for taking massive, concentrated bets, but never ones that could sink the ship. He buys entire companies, but he does so with Berkshire's cash and insurance float, not with leverage that could bankrupt the holding company. This mental model forces you to separate recoverable risks from irrecoverable ones. It shifts your primary focus from "how much can I make" to "how can I guarantee I will be able to play tomorrow." It's the ultimate tool for capital preservation, because it recognizes that the only number that truly matters in the long run is the one that isn't zero. The path walked by the 99% is paved with the seductive promise of acceleration. In an era of instant gratification, the slow, methodical process of wealth building feels archaic. This impatience leads investors directly to the tools of their own destruction, and margin is chief among them. The journey almost always begins the same way. A retail investor, perhaps new to the market, opens an account on a sleek, user-friendly trading app. They make a few good trades. They buy a popular stock, it goes up 10%, and they feel a surge of validation. They are good at this. Then they discover a little toggle switch, a button that says Enable Margin. The broker offers them what seems like free money, a line of credit equal to their own capital. The pitch is irresistible. Amplify your gains. Why make 10% when you can make 20%? Their brain, already primed by recent success, sees only the upside. They flip the switch. They take out a small margin loan to buy more of that winning stock. The stock continues to rise. Their $10,000 portfolio is now worth $12,000. But because they used margin, their actual equity has grown by 40%, not 20%. The feeling is intoxicating. They have transcended the normal rules. They are not just an investor. They are a sophisticated trader. This is the path of the 99%. They mistake leverage for skill. They confuse a bull market for genius. They start to view their margin limit not as a line of credit, but as part of their own capital. They talk about their $250,000 portfolio, when, in reality, they only have $125,000 of their own money at risk. Then, the inevitable happens. The market turns. It could be a bad inflation report, a geopolitical crisis, or just a random Tuesday when sentiment shifts. Their high-flying tech stock drops 15% in a day. An unleveraged investor would be disappointed. They would see their portfolio value decline, but their life wouldn't change. They still own the same number of shares. But our leveraged investor faces a different reality. The 15% drop in the stock price translates into a 30% loss of their actual equity. The panic begins to set in. The app, once a source of euphoria, is now a portal of dread. The next day, the stock drops another 15%. Now, their personal capital has been slashed by 60%. They receive the email. The subject line is cold and clinical, margin call. The broker informs them that their equity has fallen below the minimum maintenance requirement. They have two choices: deposit more cash into the account immediately, or the broker will begin selling their shares to cover the loan. They don't have the cash. They are forced to watch, helpless, as the system automatically liquidates their position at the worst possible price, locking in a catastrophic loss. In the span of 48 hours, they have gone from feeling like a financial wizard to being nearly wiped out. And the cruelest part is that weeks later, the market recovers. The stock they were forced to sell rebounds and goes on to new highs. But they are not there to see it. They are on the sidelines, their capital gone, locked out of the very recovery that would have saved them. This is the antithesis of Buffett's approach. It is the pursuit of speed over sustainability, the triumph of greed over arithmetic, and it is the reason why the vast majority of people who use leverage to trade stocks ultimately end up with less money than they started with, or worse, with a debt to their broker and a spirit broken by the finality of ruin. The financial connection between leverage and ruin is not philosophical, it is brutal, mathematical, and unyielding. It fundamentally alters the arithmetic of your portfolio and introduces a fragility that is impossible to overstate. Let's quantify the impact on a balance sheet. Imagine a simple investor. Let's call her Prudent Penny. She has $100,000 in cash. She invests it all in an S&P 500 index fund. Her personal balance sheet is simple: assets of $100,000, stock, and no liabilities. Her net worth is $100,000. Now consider another investor, Margin Mike. He also has $100,000 in cash, but his broker offers him a margin loan, and he takes it, borrowing another $100,000 to buy a total of $200,000 worth of the same index fund. His balance sheet looks different. Assets of $200,000, stock, but also liabilities of $100,000, margin loan. His net worth is still $100,000. On day one, they appear to be in the same position. Now, let's introduce a standard market correction, a 20% drop. For Prudent Penny, this is unpleasant. Her $100,000 in stock is now worth $80,000. Her net worth has dropped by 20%. It's a paper loss. She still owns all her shares. She can wait for the market to recover. For Margin Mike, the situation is far more dire. His $200,000 stock position is now worth $160,000, but he still owes the broker $100,000. So his net worth, assets, liabilities, is now $160,000 minus $100,000 equals $60,000. A 20% drop in the market has resulted in a 40% loss of his personal capital. The leverage has doubled the impact of the loss. Now let's escalate this to a severe bear market, the kind that happens every decade or so, a 50% drop, like in 2008, or the dot-com bust. For Prudent Penny, her $100,000 portfolio is now worth $50,000. This is devastating. It might take years to recover. But she is still in the game. Her capital is halved but not eliminated. For Margin Mike, the 50% drop is a game-over event. His $200,000 stock position is now worth $100,000. He still owes the broker exactly $100,000. His net worth has fallen to zero. He has been completely and totally wiped out. Any further drop, even one more percentage point, and he will not only have lost all his own money, but he will be in debt to his broker. This is the direct financial manifestation of the one-way gate. Leverage introduces an asymmetry of outcomes. The upside is capped. You can double your gains. But the downside is not just doubled. It introduces the possibility of a 100% loss, and even more. This single factor transforms investing from a positive-sum game of long-term ownership into a zero-sum game of short-term survival. This is the core of capital preservation, structuring your finances so that no single market event, no matter how severe, can force you to zero. By refusing to borrow, you are making a deliberate choice to remove the possibility of a catastrophic outcome from your financial life. You are ensuring that your balance sheet can bend during a storm but never, ever break. The human mind has a dangerous affinity for stories that sound too good to be true, especially when those stories involve money. We are wired to seek out patterns and opportunities that promise outsized rewards with what we perceive as minimal risk. This leads us to the grand fallacy of the sure thing, the belief that a particular investment is so obviously destined for success that it justifies breaking the cardinal rules of risk management. It's the whisper in your ear that says, "This time is different." Warren Buffett's longtime partner, the brilliant and perpetually cantankerous Charlie Munger, learned this lesson in the most painful way imaginable. Long before he became the vice chairman of Berkshire Hathaway, Munger was a successful lawyer and a private investor running his own partnership. By the early 1970s, he had done exceptionally well. He was a millionaire, a testament to his sharp intellect and disciplined approach. But even a mind like Munger's can fall prey to temptation. He made two highly leveraged investments that he considered to be near certainties. One was in a company that he and his partners controlled, and the other was a large real estate development. He borrowed heavily to finance these positions, convinced of their inevitable success. Then, in 1973 and 1974, the market was hit by one of the most brutal bear markets of the 20th century. The Nifty 50 stocks, the one-decision blue chips of their day that everyone believed were sure things, collapsed. The entire market was crushed, and the economy slid into a deep recession. The value of Munger's leveraged positions plummeted. Simultaneously, the real estate market seized up. The project he was so confident in was suddenly facing immense headwinds. Munger found himself in a terrifying position. As the value of his assets fell, his debts remained fixed. He was getting margin calls and facing a liquidity crisis that threatened to bankrupt him entirely. He has spoken about this period with a haunting clarity. He describes the intense psychological pressure, the feeling of his stomach churning, the realization that he, Charlie Munger, a man of profound intellect and rationality, was on the verge of being wiped out by his own hubris. He was forced to sell other assets at depressed prices to meet his obligations. He survived, but just barely. The experience was a crucible that forged his and Buffett's shared philosophy on debt. Munger has said, "I had a friend who was a wonderful, brilliant guy, but he was a compulsive gambler. And he would go to Vegas, and he would win and win and win, and then lose it all back. You can't have a 100% certainty in this world. If you use leverage, you're taking on a risk that can wipe you out, and it's just not worth it. Munger's near ruin demonstrates the core danger of the sure thing mentality. It doesn't matter how brilliant you are or how certain you feel. The world is a complex, chaotic system. Black swan events happen. The sure things of today are often the cautionary tales of tomorrow. Had Munger been wiped out in 1974, the world would have never known the wisdom of Charlie Munger, the partner of Warren Buffett. The entire magnificent story of Berkshire Hathaway might have been different. His brush with disaster serves as a permanent reminder that the only true sure thing in finance is that the future is uncertain, and that borrowing money against an uncertain future is a fool's errand. The psychological trap of the sure thing is woven from two powerful cognitive biases: recency bias and confirmation bias. These two forces work in tandem to create a dangerous echo chamber inside an investor's mind, convincing them that their chosen investment cannot possibly fail. Recency bias is the tendency to give greater importance to recent events than to historical ones. When a stock, a sector, or an entire market has been on a tear, our brains begin to normalize this upward trajectory. We see a tech company whose stock has doubled every year for the past 3 years, and our mind intuitively projects that trend into the future. The recent past feels more real, more predictive than the distant memory of the dot-com bust or the 2008 crisis. This bias makes us forget the fundamental principle of reversion to the mean. Trees don't grow to the sky, and exponential growth in a competitive market is incredibly difficult to sustain. Yet, the dopamine rush of seeing our portfolio go up day after day short-circuits our long-term memory. We start to believe that this new paradigm, where our chosen stock only goes up, is permanent. Once recency bias has anchored our belief in the sure thing, confirmation bias comes in to fortify the walls of our conviction. Confirmation bias is the natural human tendency to search for, interpret, favor, and recall information that confirms or supports one's pre-existing beliefs. If you believe that electric vehicles are the future and that a specific EV company is the guaranteed winner, you will subconsciously filter the world for evidence that supports this view. You will eagerly consume news articles about their record delivery numbers. You will watch interviews with the charismatic CEO and nod along. You will frequent online forums where fellow believers share bullish theories. At the same time, you will dismiss, downplay, or completely ignore any disconfirming evidence. An article about rising competition from legacy automakers? They're too slow. They'll never catch up. A research report highlighting the company's insane valuation? The analysts don't understand disruptive technology. News of a key executive resigning? He was probably deadweight anyway. On a cerebral level, your brain is actively trying to avoid cognitive dissonance, the mental discomfort experienced when holding two or more contradictory beliefs. It's easier and more pleasant for your brain to reinforce what it already thinks it knows than to grapple with challenging information. This creates a powerful feedback loop. The more you believe in the sure thing, the more you seek out information that confirms it, which in turn strengthens your belief, making you even more certain and more willing to take extreme risks, like using leverage, to maximize your exposure to what you now see as an inevitable outcome. This is how smart people convince themselves to make catastrophically foolish bets. To dismantle this dangerous mental echo chamber, you must adopt a framework of structured skepticism. The most effective tool for this is a combination of two powerful mental models, inversion and the pre-mortem analysis. These models force you to abandon your comfortable assumptions and actively engage with the possibility of failure. Inversion, a concept championed by Charlie Munger, is the practice of tackling a problem by thinking about it in reverse. Instead of asking, "How can I make this investment a success?" you ask, "What are all the ways this investment could fail?" The blueprint for applying inversion is simple but profound. Step 1. Clearly state your investment thesis. For example, I believe Company X will succeed because of its superior technology and visionary leadership. Step 2. Invert the statement. Your new task is to build the strongest possible case for the opposite outcome. Company X will fail spectacularly. Now, prove it. Step 3. Generate a comprehensive list of all the potential causes of failure. Do not hold back. Think like the most cynical short seller on Wall Street. Could their technology be leapfrogged by a competitor? Could the visionary CEO be a fraud or get into a scandal? Could a change in government regulation destroy their business model? Could a recession crush demand for their luxury product? Could their supply chain be disrupted? Could they be hiding massive debt on their balance sheet? By forcing yourself to argue against your own position, you pop the bubble of confirmation bias. You are now actively seeking disconfirming evidence, which gives you a much more balanced and realistic view of the risks involved. This leads directly to the second mental model, the pre-mortem analysis. This is an exercise developed by psychologist Gary Klein. Imagine you are in a boardroom. The investment has been made, but now you project yourself 1 year into the future. The investment has been an unmitigated disaster. It has failed completely, wiping out all the capital invested. Now your task is to write the history of that failure. Step 4 of the blueprint. Spend 10 to 15 minutes writing a detailed narrative explaining exactly what went wrong. The reason this investment failed was it a single catastrophic event or a death by 1,000 cuts? Was it an internal failure of management or an external market shock? By framing the failure as a certainty that has already happened, you liberate yourself from the emotional attachment to success. It's no longer a scary hypothetical. It's a historical fact you are simply documenting. This process uncovers risks that are often missed in a standard pros and cons analysis. It makes the abstract threat of loss feel real and visceral. After performing an inversion and a pre-mortem, look at your original thesis. Does it still feel like a sure thing? Almost certainly not. You will have a newfound appreciation for the myriad ways the future can defy your expectations. And the idea of borrowing money to bet on that single fragile thesis will suddenly seem not just risky, but utterly insane. This framework doesn't guarantee you'll always be right, but it guarantees you will think better, and it will inoculate you against the kind of blind conviction that leads to leveraged ruin. The antithesis to this disciplined, skeptical approach is the path of the 99%, the path of the true believer, fueled by narrative, community, and the promise of a financial revolution. We saw this play out with breathtaking intensity during the meme stock phenomenon of 2021. This was not just about making money, it was a crusade. Small retail investors, organized on forums like Reddit's Wall Street Bets, banded together to take on the hedge funds that were heavily shorting stocks like GameStop, a struggling video game retailer, and AMC, a movie theater chain battered by the pandemic. The narrative was powerful and intoxicating. It was a David versus Goliath story. It was a chance to punish the Wall Street elite for the 2008 financial crisis. Investing in these stocks became a statement of identity. The language was that of warfare and faith. Apes together strong. Diamond hands holding on no matter what, to the moon. In this environment, the stocks ceased to be businesses with underlying fundamentals. They became symbols of a movement. This transformed them, in the minds of many, into the ultimate sure thing. The thesis wasn't based on price-to-earnings ratios. It was based on the belief that if everyone just held on, the hedge funds would be forced to buy back their shares at any price, triggering a short squeeze of infinite proportions. This absolute conviction, divorced from financial reality, was the perfect psychological breeding ground for the use of leverage. People poured their life savings into these stocks. Then, they took out margin loans to buy more. They used options, a form of implicit leverage, to make even bigger bets. They posted screenshots of their massively leveraged positions, which were celebrated by the community as acts of bravery, further reinforcing the behavior. For a brief, dizzying period, it worked. GameStop's stock price soared from under $20 to nearly $500. Fortunes were made overnight. The believers felt vindicated. Their faith was rewarded. But the law of financial gravity is patient. The squeeze eventually ran out of steam. The narrative began to fray. The stock prices, unmoored from any semblance of fundamental value, began their inevitable and brutal descent. For the unleveraged investor who got in early and sold, it was a spectacular win. But for the legions who got in late, who bought at the top, and especially for those who used margin, it was a massacre. As the price collapsed, the margin calls came. The forced liquidations began, adding to the selling pressure and accelerating the crash. People who had seen their accounts swell to millions on paper were wiped out in a matter of days. The forums that were once filled with triumphant posts were now flooded with stories of unimaginable loss. People losing their homes, their retirement funds, their entire financial futures. They fell victim to the most dangerous, sure thing of all, the belief in the infallibility of the crowd. They ignored the fundamental rule because they believed that this time, truly, was different. But it wasn't. The mechanics of leverage are indifferent to narratives, and the finality of ruin is the same, whether you lose it all on a railroad stock in 1929 or a meme stock in 2021. The direct financial connection between the sure thing fallacy and a portfolio's health is the catastrophic destruction of diversification. Diversification is the only free lunch in investing. It is the core principle of modern portfolio management, the primary tool for managing risk you cannot control. By spreading your investments across various assets, industries, and geographies, you ensure that the failure of any single investment does not mortally wound your entire portfolio. The sure thing mentality is the arch nemesis of diversification. When you become convinced that one particular stock is a guaranteed ticket to riches, a powerful impulse takes over, the desire to concentrate. Why would you own 20 different stocks if you know with absolute certainty that this one stock will outperform all the others combined? This leads to an overconcentration of capital. An investor might put 30%, 50%, or even more of their portfolio into their one big idea. This is already a risky strategy. But when you combine this overconcentration with leverage, you create a ticking time bomb. Let's look at the math. Imagine a well-managed portfolio of $100,000, diversified across 20 stocks, with no single position making up more than 5% of the total. If one of those companies, worth $5,000 in the portfolio, unexpectedly goes bankrupt, the total portfolio loss is 5%. It's painful, but not life-altering. The other 19 positions can continue to grow, and the portfolio will recover. Now consider the sure thing investor. They also have $100,000. They put all of it into one stock, Company X. Then, convinced of its inevitable rise, they borrow another $50,000 on margin to buy even more. Their portfolio is now $150,000, all concentrated in a single, leveraged position. If that sure thing suddenly fails, perhaps due to a massive accounting fraud being revealed, and the stock goes to zero, the outcome is not a 5% loss. It is a 100% loss of their own capital, plus they are now $50,000 in debt to their broker. The single leveraged bet has not just created a loss, it has created a liability that follows them into the rest of their financial life. This is how the sure thing fallacy poisons an entire wealth management strategy. It encourages behavior that is the exact opposite of what is required for long-term capital preservation. It systematically dismantles the safety features of a portfolio. Even if the leveraged, concentrated bet works out a few times, the one time it fails is enough to undo all the previous successes and then some. It's a strategy that has to be right 100% of the time, in a world where nothing is 100% certain. This is why Buffett and Munger are so adamant. They understand that the key to wealth is not finding the one perfect investment, but building a robust system that can survive a multitude of imperfect outcomes. And that system is fundamentally incompatible with the twin poisons of overconcentration and leverage. There is a moment in the life of a leveraged investor that is unlike any other. It is a moment of profound and terrifying transformation, where you go from being the master of your own financial destiny to a helpless passenger in a car careening towards a cliff. This is the moment you receive a margin call. It is the mechanical embodiment of tyranny, a point where the rules of the game are enforced upon you by an unemotional, unforgiving third party, your broker. The story of Bill Hwang and his family office, Archegos Capital Management, is perhaps the most spectacular margin call implosion in modern history. In March of 2021, in the span of just a few days, a fortune estimated to be as large as $30 billion simply vanished. Bill Hwang was not a novice. He was a seasoned, aggressive investor, a so-called tiger cub who had honed his craft at a legendary hedge fund. After running into regulatory trouble earlier in his career, he converted his fund into a family office, managing his personal fortune. This structure freed him from many of the disclosure requirements that apply to hedge funds, allowing him to operate in the shadows. His strategy was built on two pillars: extreme concentration and breathtaking leverage. He took massive concentrated positions in a handful of stocks, primarily in the media and tech sectors, companies like Viacom CBS, Discovery, and several Chinese tech firms. But he didn't buy these stocks directly. He used a type of derivative known as a total return swap. Essentially, he paid banks like Goldman Sachs, Morgan Stanley, and Credit Suisse a fee, and in return they would buy the stocks on his behalf. This had two effects. It hid the true size of his positions from the public, and it allowed him to achieve enormous leverage, reportedly as high as 5-to-1. For every $1 billion of his own capital, he was controlling $5 billion worth of stock. For a long time, as the market roared upwards post-pandemic, this strategy was phenomenally successful. His wealth grew at an astonishing rate. But he had built a house of cards on a fault line. In late March 2021, one of his key holdings, Viacom CBS, announced a secondary stock offering to raise cash. The market reacted poorly, and the stock price began to fall. This drop, while significant, would have been a manageable event for a normal investor. For Archegos, it was the first tremor of a cataclysmic earthquake. The decline in Viacom CBS's stock price eroded the value of Hwang's collateral with the banks. One of his prime brokers, likely Morgan Stanley or Goldman Sachs, got nervous. They made the call. They demanded more capital to cover the potential losses on their swaps. This was the margin call. But Hwang didn't have the liquid cash to meet it. He was fully invested, fully leveraged. The moment he failed to meet that call, control was ripped from his hands. The bank's risk management department took over. They had one priority: save the bank's money. They began to liquidate the massive blocks of Viacom CBS stock they held on behalf of Archegos. This huge wave of selling pressure flooded the market, causing the stock price to plummet even further. This, in turn, triggered margin calls from all the other banks that had dealt with Archegos. A contagion of fear spread through Wall Street as bankers realized the true, hidden size of Hwang's positions. A frantic race to sell began. On Friday, March 26th, the market witnessed a fire sale of historic proportions. Billions of dollars worth of stock in Viacom CBS, Discovery, and other Archegos-linked names were dumped in massive block trades, causing their prices to crash by 30%, 40%, even 50% in a matter of hours. By the end of the day, Archegos Capital Management was functionally insolvent. A $30 billion fortune, built over years, was annihilated in less than a week. Bill Hwang was powerless to stop it. He could only watch as the banks he had enriched for years systematically dismantled his empire to protect themselves. This is the ultimate tyranny of the margin call. Your assets are no longer yours to command. Your long-term thesis is irrelevant. Your belief that the stock will recover is meaningless. The decision to sell is made for you, at the worst possible time, for the worst possible price, by someone whose only interest is their own self-preservation. The psychological experience of a margin call is a unique form of torture, a direct assault on our most deeply ingrained cognitive biases. The two most relevant here are loss aversion and the endowment effect. Loss aversion, a concept identified by psychologists Daniel Kahneman and Amos Tversky, describes our tendency to feel the pain of a loss approximately twice as powerfully as the pleasure of an equivalent gain. Losing $100 feels as bad as winning $200 feels good. This is why we hate to sell our losing investments. The act of selling transforms a paper loss into a real, permanent one. Our brain fights against this confirmation of failure. We tell ourselves, "I'll just hold on until it gets back to what I paid for it." This is often irrational, but it's a powerful emotional impulse designed to avoid the sharp pain of crystallizing a loss. A margin call obliterates this coping mechanism. It is a forced realization of your loss against your will. The pain is magnified because you have no agency in the decision. It is an external force confirming your failure in the most brutal and public way possible. Compounding this pain is the endowment effect. This is our tendency to ascribe more value to things simply because we own them. That stock in your portfolio isn't just a ticker symbol. It's your Triime Terrorist stock. You've researched it, you've followed its story, you've emotionally invested in its success. It becomes part of your identity as an investor. The endowment effect makes it difficult to part with our possessions, even when it's rational to do so. A margin call is the ultimate violation of the endowment effect. Not only is your cherished possession being taken from you, but it's being sold for a fraction of what you believe it's worth. The broker doesn't care about the company's long-term prospects or your emotional attachment. To them, it is just collateral, a number on a screen that must be liquidated. This combination creates a state of profound psychological distress. You feel a loss of control, a sense of violation, and an overwhelming feeling of helplessness. The event is so traumatic that for many, it causes them to abandon investing altogether. They associate the stock market with this peak negative experience, this moment of ultimate powerlessness. They are not only financially ruined, but also psychologically scarred, unable to participate in the greatest wealth creation engine in history, because the one time they tried to take a shortcut, it led them off a cliff. This is a harm that goes far beyond the money lost. It's the destruction of future opportunity. To ensure you never face this tyranny, you must build your financial life around a mental model that prioritizes sovereignty above all else. This is the control test, a simple question that serves as a gatekeeper for all your financial commitments. The model is based on a fundamental distinction: the difference between being an owner and being a custodian. When you own an asset outright, with no debt attached, you have absolute control over its disposition. You decide when to buy, when to hold, and when to sell. The market may fluctuate, but your ownership is not contingent on that fluctuation. When you use leverage, you are no longer the absolute owner. You are a custodian, holding the asset on behalf of your creditor. Your ownership is conditional. It is contingent on the value of the asset remaining above a certain threshold. If it falls below that line, your creditor, the true master of the asset, can and will step in. The blueprint for applying the control test is a single, non-negotiable question to be asked before you acquire any asset. At any point in the future, can someone else force me to sell this asset at a time not of my choosing? Let's apply it. Buying a stock with cash in a brokerage account. Can your broker force you to sell it? No, you own it. It passes the control test. Taking out a mortgage to buy a house. Can the bank force you to sell it? Yes. If you fail to make your payments, they can foreclose. It fails the control test in that specific scenario, which is why maintaining a stable income and an emergency fund is so critical for homeowners. Now the crucial one, buying a stock on margin. Can your broker force you to sell it? Yes, absolutely. If the stock's value drops and your equity falls below the maintenance margin, They have the legal right and the financial incentive to liquidate your position without your permission. It fails the control test spectacularly. By making this question a core part of your financial decision-making process, you are drawing a clear line between the world of investing and the world of speculation. You are committing to operating only in arenas where you retain 100% of the agency. This has profound implications. It means you can truly afford to be a long-term investor. You can watch a stock you own drop 50% in a crisis, and while it's painful, you are never forced to act. You can hold on, you can buy more if your thesis is still intact, and you can wait patiently for the eventual recovery. You are insulated from the panic of the market because your ownership is not in question. This is the source of Buffett's famous temperament. It's not just that he's emotionally calm, it's that he has structured his entire financial existence through Berkshire Hathaway to ensure he is never a forced seller of anything. He is always in control. The control test is your personal mechanism for achieving that same state of financial sovereignty, ensuring you are always the master of your own capital. The path of the 99% is one of perpetual, low-grade anxiety, a life lived on the edge of a financial precipice. It is the life of the person who receives the margin call email and the world stops. Let's paint that picture. It's 9 p.m. on a Tuesday. The market has been ugly for 3 straight days. The tech-heavy portfolio, once a source of pride and exciting dinner-table conversation, is bleeding. The investor, let's call him Tom, does a final check of his brokerage app before bed, a habit born of anxiety. His heart sinks as he sees the sea of red. Then, he sees the email notification on his phone. The subject line from his broker is sterile. Important notice regarding your account. A knot forms in his stomach. He opens it. The text is dense with legal jargon, but a few words jump out. Margin requirement. Account deficit. Immediate action required. Liquidation. The panic is instantaneous and overwhelming. His first reaction is denial. This can't be happening. The stock will bounce back tomorrow. The pre-market futures will be green. It's just a temporary dip. He stays up all night, frantically refreshing news sites, searching for any glimmer of hope, any piece of analysis that suggests a massive rally is coming. Sleep is impossible. The next morning, the market opens down again. The dreaded number on his screen, the house call amount, grows larger. He has until the end of the day to either deposit thousands of dollars he doesn't have, or the broker will start selling. He feels a profound sense of helplessness. His financial future is being decided by the red and green ticks of a stock chart, completely outside of his control. He thinks about the plans he had for that money, the down payment on a house, his kid's college fund. He feels a wave of shame and regret so intense it's nauseating. Why did he get so greedy? Why did he believe it was so easy? Just before the market closes, it happens. He gets a series of notifications on his phone. Your order to sell 100 shares of XYZ has been executed. Your order to sell 250 shares of ABC has been executed. The system is dismembering his portfolio, piece by piece, locking in the devastating losses. By 4 p.m., it's over. His once promising portfolio is a smoldering ruin. He is left with a fraction of his initial capital, his dreams in tatters. The ultimate cruelty is that the market bottoms a week later and begins a steady climb back. The very stocks he was forced to sell are now soaring. But he can't participate. He is out of the game, a spectator to the recovery he should have been a part of. This story, in variations, plays out for countless investors in every market cycle. It is the predictable, tragic endpoint of a journey that begins with the tempting whisper of, "Amplify your gains." It is the harsh reality of surrendering control to your broker, and it is the starkest possible illustration of the antithesis to Buffett's iron rule of financial survival. The direct financial connection here revolves around the critical distinction between solvency and liquidity. Understanding this difference is fundamental to building a resilient financial life, and explains exactly why a margin call is such a uniquely destructive event. Liquidity refers to your ability to meet your short-term obligations. It's about having access to cash. you can be incredibly wealthy on paper but still be illiquid. For example, a real estate developer might own billions of dollars in buildings but have very little cash on hand. Solvency, on the other hand, is about your net worth. You are solvent as long as your total assets are greater than your total liabilities. If your liabilities exceed your assets, you are insolvent, which is the technical definition of being bankrupt. An unleveraged investor who experiences a market crash faces a liquidity problem, but not a solvency problem. Let's go back to Prudent Penny with her $100,000 cash investment. When the market drops 50%, her stock portfolio is worth $50,000. Her net worth is $50,000. She is still perfectly solvent. Her assets of $50,000 are greater than her liabilities of zero. If she needs cash for an emergency, she has a liquidity problem. She might have to sell stocks at a bad price, but the underlying ownership and her solvency are never in question. Now let's look at Margin Mike's balance sheet at the moment of a margin call. He started with $200,000 in assets, stock, and $100,000 in liabilities, margin loan, for a net worth of $100,000. The market drops 40%. His assets are now worth $120,000. His liability is still $100,000. His net worth is $20,000. The broker's maintenance margin requirement is typically around 25% of the total asset value. 25% of $120,000 is $30,000. His current equity of $20,000 is below this threshold. The margin call is triggered. The broker isn't calling because they are mean. They are calling because Mike is getting dangerously close to insolvency. The broker's loan is at risk. If the stock drops further, Mike's assets will be worth less than his liabilities, and the broker will lose money. The forced sale is a self-preservation move by the broker. It transforms Mike's temporary paper loss into a permanent, real-world solvency event. The sale crystallizes the loss, his net worth is locked in at a fraction of its former value, and his ability to recover is destroyed. This is the crucial link. A margin call is the mechanism by which a temporary market downturn is converted into a permanent solvency crisis for the leveraged investor. It takes a problem that time could heal and makes it instantly fatal. By avoiding leverage, you are ensuring that your financial problems, even in a severe crisis, remain problems of liquidity, not solvency. And as long as you are solvent, you have the most powerful asset of all on your side: time. There is a profound and often underestimated power in simply not going to zero. In a world obsessed with explosive growth and 10-bagger returns, we forget that the most powerful force in the financial universe is compounding, and the only way to harness that force is to stay in the game, uninterrupted, for a very long time. Avoiding leverage is not a defensive strategy. It is the ultimate offensive strategy because it guarantees your presence on the field for every future inning. The perfect illustration of this is Warren Buffett's investment in the Coca-Cola Company. The year was 1988. The market was still deeply scarred by the Black Monday crash of October 1987, when the Dow Jones Industrial Average fell by nearly 23% in a single day. Fear was the dominant emotion. Many investors believed the great bull market was over, and they fled equities for the perceived safety of cash and bonds. But Buffett, operating from his fortress of cash at Berkshire Hathaway, saw something different. He saw not a crisis but an opportunity. He looked at Coca-Cola, a globally dominant brand with predictable earnings and a massive competitive moat, and saw that its stock was trading at a reasonable price, largely due to the pervasive market pessimism. Over a period of several months in 1988 and 1989, Berkshire Hathaway began to buy shares of Coca-Cola. And they didn't just nibble, they bought aggressively. By the time they were done, they had invested over $1 billion, acquiring a stake of around 7% of the entire company. It was one of the largest single investments Berkshire had ever made. The crucial part of this story is not just what he bought, but how he was able to buy it. At a time when other investors were panicked, selling, or licking their wounds from leveraged bets that had gone bad in the '87 crash, Buffett was calm, rational, and, most importantly, liquid. Berkshire's balance sheet was a fortress, deliberately structured without the kind of leverage that could force their hand. They had billions in cash and cash equivalents, the financial oxygen, that allowed them to breathe easily while everyone else was suffocating. This gave them the ability to act decisively, to be greedy when others were fearful. Had Buffett's operations been leveraged, the 1987 crash could have been a devastating blow, forcing him to sell assets and raise cash. Instead, it was the catalyst for one of his greatest investments. He was in the game, with capital, at the precise moment of maximum opportunity. That $1 billion investment has since paid Berkshire tens of billions of dollars in dividends alone. And the value of the stock itself has compounded astronomically over the subsequent 3 decades. That single decision, made possible by a debt-free balance sheet, has created more wealth than most entire corporations generate in their lifetimes. This is the power of staying in the game. It's not just about surviving the downturns. It's about having the financial and psychological strength to exploit the opportunities that those downturns inevitably create. Leverage robs you of this power. It forces you to play defense during the very moments you should be playing offense. By choosing to stay unleveraged, you are choosing to be the person who brings cash to the fire sale, not the person whose assets are being sold. The psychological principle that underpins this stay-in-the-game advantage is what can be called time horizon arbitrage. In finance, arbitrage is the act of exploiting a price difference between 2 or more markets. Time horizon arbitrage is the exploitation of the difference in time perspectives between various market participants. The vast majority of market players, especially those who are highly leveraged, are forced to operate with an extremely short time horizon. A hedge fund manager is judged on their quarterly performance. A day trader using margin is judged on their minute-by-minute performance. Their decisions are driven by the immediate need to manage their leverage and avoid a margin call. A 10% dip in a stock is, for them, a potential crisis. This short-term focus forces them into a state of chronic financial anxiety. The part of their brain responsible for cool, long-term, rational thought, the prefrontal cortex, is constantly being hijacked by the amygdala, the brain's fear center. They are biologically primed to make reactive, pro-cyclical decisions, buying high in a frenzy of greed and selling low in a fit of panic. The unleveraged, long-term investor, by contrast, has the luxury of a multi-decade time horizon. When you invest with cash you won't need for 5, 10, or even 50 years, your entire psychological disposition changes. You can effectively arbitrage the panic of the short-term players. When they are frantically selling during a crash to meet margin calls, you can calmly and rationally assess the situation. You can see the 10% dip not as a crisis but as what it truly is, a temporary fluctuation in the long-term journey of a business. This allows your prefrontal cortex to remain firmly in control. You can think clearly, analyze fundamentals, and stick to your predetermined investment strategy. You can view market volatility as an opportunity, not a threat. This is the single greatest advantage a retail investor has over the so-called smart money on Wall Street. You don't have a boss demanding to know why your portfolio is down this quarter. You don't have clients who will pull their money at the first sign of trouble. Your only boss is your own long-term financial plan. But the moment you introduce leverage into your portfolio, you voluntarily surrender this incredible advantage. You are willingly shortening your own time horizon. You are adopting the same constraints and psychological pressures as the most frantic short-term speculator. You are choosing to fight the game on their terms, a game which is incredibly difficult to win. By staying unleveraged, you are preserving your psychological capital as much as your financial capital, allowing you to play the long game, which is the only game that is reliably winnable. To operationalize this principle of survival and long-term thinking, you can implement a mental model known as the barbell strategy. Popularized by the author and risk analyst Nassim Nicholas Taleb, this strategy is designed to create a portfolio that is both extremely robust and has exposure to massive upside. It is the ultimate stay-in-the-game structure. Imagine a barbell, with most of the weight on the two ends and very little in the middle. A barbell investment strategy mirrors this structure. On one side of the barbell, you place the vast majority of your capital, typically 80% to 90%, in extremely safe, conservative, and unleveraged assets. This could be a portfolio of broad market index funds, a collection of high-quality blue-chip dividend-paying stocks, or even government bonds and cash. The key characteristic of this side of the portfolio is that it is designed for survival. It cannot be wiped out by a single market event. It is your fortress of capital preservation. On the other, far smaller side of the barbell, you place a tiny fraction of your capital, say 10% to 20%, in extremely high-risk, high-reward ventures. These are your moonshots. This could be an investment in a handful of speculative biotech startups, cryptocurrencies, or options contracts on a stock you believe has explosive potential. The crucial rule here is that you can afford to lose 100% of the money on this side of the barbell. If every single one of your speculative bets goes to zero, it's a 10% hit to your overall portfolio. It's painful, but it's not a catastrophic, game-ending event. The safe 90% of your portfolio remains intact. What this strategy does is eliminate the mushy middle. Most people invest in the middle, medium-risk stocks, corporate bonds, etc. Taleb argues this is the most dangerous area, as these assets can be subject to black swan risks that are not properly accounted for. The barbell strategy, in contrast, is explicitly anti-fragile. It is structured to benefit from volatility. In a normal or bull market, the safe portion of your portfolio chugs along, compounding steadily. Your speculative bets might do nothing, or one might pay off handsomely. In a market crash, your speculative side might get wiped out, but your safe side will preserve your capital. And because you have preserved your capital, you are now in a position to take a small amount from your safe side and reinvest it in the now decimated speculative assets at bargain basement prices. This is the blueprint. Step 1. Determine your split. For most people, 90/10 is a good starting point. Step 2. Build your safe side. Automate contributions to low-cost index funds. Buy and hold shares of stable, profitable companies. Do not use leverage on this side under any circumstances. This is your foundation. Step 3. Allocate your play money. Take the remaining 10% and make your speculative bets. Be aware that this is high risk. Treat it as a learning experience. If it goes to zero, you have learned a valuable lesson without destroying your financial future. This model allows you to satisfy the human desire for exciting, high-growth opportunities while ensuring that your core financial health is never, ever put at risk. It is the perfect marriage of aggressive offense and impenetrable defense. The antithesis of the barbell strategy and the stay-in-the-game mindset is the pervasive and destructive get-rich-quick mentality. This is the mindset that views the stock market not as a mechanism for owning fractional shares of real businesses, but as a giant casino. It is a mindset driven by impatience, envy, and a fundamental misunderstanding of the mathematics of wealth. The get-rich-quick speculator sees Buffett's approach of compounding wealth at 20% a year as painfully slow. They don't want to be rich in 40 years. They want to be rich by next Friday. This impatience leads them to reject sound investment strategies in favor of financial instruments that offer the illusion of a shortcut. They are drawn to day trading, buying and selling stocks multiple times a day to scalp tiny profits. They gravitate towards penny stocks, hoping to turn $1,000 into $1 million by finding the next Microsoft in its infancy. They become obsessed with short-term options trading, making highly leveraged bets on a stock's direction over the next few days or weeks. And, of course, they embrace margin, seeing it as the fuel needed to accelerate their journey. The analogy of the marathon is perfect here. Building wealth is a marathon, a 26.2-mile race. The disciplined, unleveraged investor is the runner who maintains a steady, sustainable pace. They are not the fastest out of the gate, but they conserve their energy, stick to their plan, and finish the race strong. The get-rich-quick speculator is the person who decides to sprint the first mile of the marathon. For a few minutes, they look like a superstar. They are far ahead of the pack, and the crowd cheers. But their body is operating at an unsustainable level of exertion. Lactic acid builds up in their muscles. Their heart rate redlines. By mile 2, they are gasping for air. By mile 3, they have collapsed on the side of the road, completely burned out, while the steady runner jogs past, on their way to the finish line. This is precisely what happens financially. The speculator might have a few incredible months, doubling or tripling their money with high-risk leveraged bets. They feel like a genius. But their strategy is inherently unstable. It is not resilient to setbacks. A single bad trade, a sudden market downturn, a margin call, and their race is over. They don't just lose their gains, they lose their initial capital, wiping them out of the race completely. This mindset fails to appreciate the magic of compounding. It is a force that works exponentially, meaning its most powerful effects are felt in the later years. By trying to sprint at the beginning, the speculator forfeits the opportunity to experience the incredible acceleration that happens in the last few miles of the marathon. They trade the certainty of finishing the race for the slim possibility of a glorious but fleeting lead at the start. The direct financial connection between staying in the game and long-term wealth is a stark mathematical showdown, the arithmetic of compounding versus the arithmetic of ruin. The numbers are not just compelling, they are undeniable. Let's create a side-by-side comparison of two investors, both starting their journey at age 25 with $10,000. On one side, we have Compound Carla. She follows the Buffett rule. She invests her $10,000 in a low-cost index fund, adds $500 every month, and never, ever borrows a dime. Will assume a conservative, long-term average market return of 8% per year. On the other side, we have Gambler Gary. He's impatient. He wants to get rich fast. He puts his $10,000 in his brokerage account, takes out a 50% margin loan for another $5,000, and invests the total $15,000 in a handful of volatile growth stocks. He also adds $500 a month to his account. In year 1, the market is hot. Carla's portfolio grows by 8%. She's happy. Gary, thanks to his stock selection and leverage, has a phenomenal year, earning 30% on his capital. He feels like a king. In year 2, the bull market continues. Carla earns another 8%. Gary pulls off another 30% year. He now has far more money than Carla and openly mocks her slow and steady approach. In year 3, it happens again. Another 30% year for Gary. He's a genius. He feels invincible. His initial $10,000 has ballooned. But in year 4, a bear market hits. The market drops 40%. Carla's portfolio takes a significant hit. Her balance goes down, but she is still solvent. She continues to buy her $500 worth of index funds every month, now at much lower prices. Gary's volatile growth stocks get crushed, falling by 60%. His $150,000 leveraged position is now worth only $60,000, but he still owes his broker the $50,000 he borrowed. His net worth plummets to just $10,000. He gets a margin call and is forced to sell everything to cover his loan. He is essentially back to where he started, but with his confidence shattered. The market eventually recovers, but Gary has been reset to zero. Now, let's fast forward 40 years to their retirement at age 65. Gary, having been burned, maybe tried again a few times, but his strategy of high-risk, leveraged bets led to more booms and busts, never allowing for sustained growth. His final net worth is meager. Compound Carla, however, never stopped. Her account experienced ups and downs every year, but it was never wiped out. The relentless power of monthly contributions and uninterrupted compounding worked its magic. Her initial $10,000, plus her monthly savings, at an 8% annual return, has grown to over $2.1 million. The difference in their outcomes is not just large, it is total. One has achieved financial freedom. The other is facing a retirement of financial insecurity. This is the mathematical certainty that Buffett understands in his bones. The person who avoids ruin will always, over a long enough time frame, outperform the person who seeks explosive but fragile gains. Capital preservation is not just a defensive tactic. It is the most potent offensive weapon in the long-term investor's arsenal because it guarantees that the invincible force of compounding is always working for you and never against you. The final promise, the ultimate culmination of this one unbreakable rule, is not just about avoiding loss, it is about building a life of financial impregnability. It is about constructing a personal financial fortress so strong, so well designed, that it can withstand any economic storm and allow you to not only survive but thrive in the face of uncertainty. The greatest real-world example of such a fortress is not a person, but an entity, Berkshire Hathaway itself. The entire company is a masterclass in structural integrity and risk management, a direct reflection of Buffett's and Munger's core philosophy. At the heart of Berkshire's fortress is its colossal cash hoard. Buffett often refers to this pile of cash in U.S. Treasury bills, which frequently exceeds $100 billion, as a corporate necessity. He compares it to oxygen. You don't notice it when it's there, but it's the only thing you can think about when it's gone. This cash serves as a massive buffer. It ensures that Berkshire can meet all its obligations without ever having to sell its core stock holdings or businesses at inopportune times. It is the ultimate anti-margin call. But this cash is not just defensive. It is what Buffett calls dry powder. It is offensive capital, waiting patiently for the moment of maximum opportunity. This was never more evident than during the 2008 financial crisis. As the global financial system teetered on the brink of collapse and companies were desperate for capital to survive, who did they call? They called Warren Buffett. Berkshire Hathaway, the fortress, became the lender of last resort to the system. In the depths of the crisis, Buffett made legendary deals. He invested $5 billion in Goldman Sachs and $3 billion in General Electric, not in their common stock, but in preferred stock that paid a hefty 10% dividend, and he also received warrants to buy their common stock at rock-bottom prices. These were deals that were only available to him because he had the cash when no one else did. His fortress was so strong that he could calmly and confidently deploy capital into the heart of the storm, earning spectacular returns for Berkshire's shareholders. The structure of Berkshire's operations also contributes to its strength. It owns a diverse collection of dozens of whole businesses, from railroads to insurance companies, utilities, and retailers. This diversification of earnings streams makes it incredibly resilient. A downturn in one sector is often offset by stability in another. And at the core of it all is the insurance business. The float from companies like Geico, the premiums collected from policyholders that have not yet been paid out in claims, provides Berkshire with a massive, long-term source of capital that it can invest for its own benefit. It is, as Munger has noted, like having a loan from your customers that costs you nothing, or that you even get paid to hold. It is the ultimate form of anti-leverage. This is the model, a fortress built on a foundation of massive cash reserves, diversified earning streams, and a structural aversion to the kind of debt that can force your hand. It is a business designed for permanence, a blueprint for how to structure your own financial life to achieve not just wealth, but enduring financial freedom. The psychological benefit of building such a fortress is as valuable as the financial one. The core principle at play is the margin of safety, a concept Buffett learned from his mentor, Benjamin Graham. While Graham applied it to buying stocks for less than their intrinsic value, the principle can be extended to your entire financial life. Having a margin of safety in your finances, no consumer debt, a large emergency fund, unleveraged investments, is about more than just being safe. It is about engineering a state of mental tranquility that enables superior decision-making. When your financial foundation is solid, you are psychologically insulated from market volatility. A 10% drop in the stock market is, for you, an interesting event, perhaps even an opportunity. For someone leveraged to the hilt and living paycheck to paycheck, that same 10% drop is a source of existential dread. Their brain's fight-or-flight response is triggered. Cortisol, the stress hormone, floods their system. This is a state in which it is neurochemically impossible to make calm, rational, long-term decisions. They are primed for panic. By building a financial fortress, you are deliberately keeping yourself out of that state of cognitive distress. You are preserving your most important asset, your ability to think clearly. This emotional detachment allows you to adhere to your investment plan, to buy when others are panicking, and to sell when others are euphoric. It allows you to ignore the noise of the daily financial news and focus on the long-term signal. This mental peace is the true dividend of financial discipline. It is the freedom from the gnawing anxiety about bills, from the fear of a job loss, from the terror of a market crash. It is the freedom to focus your energy on your career, your family, and your passions, knowing that your financial foundation is unshakable. This is what financial freedom truly means. It is not about having a private jet or a yacht. It is about reaching a state where money is no longer a source of stress, but a tool for living a better life, a tool that you, and only you, are in complete control of. So, how do you build this fortress for yourself? It is not complex, but it requires discipline and a commitment to process. Here is the practical, step-by-step mental model, the Financial Fortress Checklist. Step 1. Eliminate the enemy within. Before you can even think about investing, you must destroy all high-interest consumer debt. This means credit card debt, personal loans, and payday loans. This is leverage working directly against you, often at rates of 20% or more. Paying off a credit card with a 22% interest rate is a guaranteed risk-free 22% return on your money. No investment in the world can offer that. This is the non-negotiable first step. You must seal the breaches in your own walls. Step 2. Build your moat. This is your emergency fund. You must save at least 6 to 12 months' worth of essential living expenses in a liquid, easily accessible savings account. This is not an investment. It is an insurance policy. This fund is your moat that protects your fortress, your long-term investments, from unforeseen life events. If you lose your job or face a medical emergency, you draw from your moat. You are never, ever forced to sell your long-term investments at a bad time to cover a short-term need. Step 3. Invest with patient capital. Once your high-interest debt is gone and your moat is full, you can begin to build the walls of your fortress. Every dollar you invest in the stock market should be money you do not expect to need for at least 5 to 10 years. This long time horizon is what gives you the psychological strength to ride out volatility. You are investing for your retirement in 30 years, not for a house down payment next year. Step 4. De-risk your environment. This is a simple but crucial action. Go into your brokerage account settings and ensure that the margin feature is disabled. Do not even give yourself the option. By removing the button, you are removing the temptation. You are making it impossible to make a catastrophic mistake in a moment of greed or overconfidence. You are architecting your environment for success. Step 5. Automate the reinforcements. The strongest fortresses are not built in a day. They are strengthened over decades, brick by brick. Set up automatic contributions from your paycheck to your investment accounts every single month. This automates the process of building wealth, enforces discipline, and takes advantage of dollar-cost averaging. By following these 5 steps, you are not just investing. You are engaging in an act of financial engineering. You are building a structure designed for resilience, for permanence, and for the peace of mind that comes from knowing that your financial future is built on a foundation of solid rock, not the borrowed sand of leverage. The path of the 99% is the antithesis of this fortress-building mindset. It is the path of the lifestyle inflation trap. This is the person who gets a pay raise and immediately sees it as an opportunity to increase their spending. A $10,000 raise doesn't go into an investment account. It goes towards the down payment on a more expensive car with a higher monthly payment. A promotion and a bonus don't get used to pay off the mortgage early. They are used to qualify for a bigger mortgage on a bigger house in a more expensive neighborhood. Their income grows, but their liabilities grow in lockstep, or even faster. Their balance sheet is a house of cards. They may look wealthy. They have the nice car, the big house, the designer clothes, but they are financially fragile. They are living paycheck to paycheck, but at a 6-figure income level. They have zero resilience. A single unexpected event can cause their entire world to collapse. A job loss means they can't make the car payment or the mortgage payment. A medical emergency with a large deductible plunges them into high-interest credit card debt. They are perpetually one step away from ruin. This constant financial stress makes sound, long-term investing impossible. They don't have the cash flow to invest consistently. And if they do manage to invest, they are doing so with a foundation of sand. The slightest tremor in their life forces them to raid their retirement accounts, selling at the worst times and paying penalties and taxes. They are trapped on a hedonistic treadmill, running faster and faster just to stay in the same precarious place. They have confused the appearance of wealth with the reality of it. The reality of wealth is not what you spend. It is what you own, free and clear. The person following the fortress checklist, even with a more modest income, is building true wealth, while the high-income lifestyle inflator is just building a more elaborate and dangerous cage for themselves. This brings us to the final and most crucial direct financial connection, the distinction between net worth and income. The 99% are obsessed with income. How much do you make a year is the standard question we use to gauge financial success. The truly wealthy, however, are obsessed with the balance sheet. They focus on growing their net worth, the value of their assets minus the value of their liabilities. Let's visualize two personal balance sheets. On the left is high-income Harry. He's a lawyer who makes $300,000 a year. It's an impressive income. But let's look at his balance sheet. He has a $1 million house with an $800,000 mortgage. He has a $70,000 luxury SUV with a $60,000 car loan. He has $20,000 in credit card debt from lavish vacations. And he has a $200,000 stock portfolio, but $100,000 of it is a margin loan. His total assets are $270,000, but his total liabilities are $980,000. His net worth is only $290,000. Despite his massive income, he is financially vulnerable. A job loss would be catastrophic. A market crash could wipe out his entire equity. On the right is balance sheet Betty. She's a teacher who makes $70,000 a year. Her income is less than a quarter of Harry's, but she has followed the fortress checklist. She lives in a modest house and she has aggressively paid down her mortgage. She only owes $50,000 on a home worth $300,000. She drives a reliable used car that is fully paid off. She has zero credit card debt. She has methodically invested in her retirement accounts for 15 years, and her unleveraged portfolio is worth $350,000. Her total assets are $650,000. Her total liabilities are only $50,000. Her net worth is $600,000. Betty, on less than a quarter of the income, has more than double the net worth of Harry. Who is wealthier? Who has more financial freedom? Who will sleep better at night during a recession? The answer is obvious. Betty's fortress is built on solid ground. Harry's is built on the borrowed sand of leverage. By committing to the one unbreakable rule, never borrow to invest, you are making a conscious decision to be like Betty. You are choosing to focus on the balance sheet, not the income statement. You are choosing resilience over appearances. You are choosing the slow, certain path to financial invincibility over the fast, fragile path to ruin. This is the final promise of Warren Buffett's one rule. It is not just a rule for the stock market. It is a philosophy for life. A blueprint for building a future where you are in control, where you are insulated from the chaos of the world, and where the relentless power of compounding is your servant, not your master. You have made it to the end, and by investing your time here, you have done more than just watch another video. You have acquired a powerful mental shield. You have learned the single most important rule for financial survival, the one non-negotiable principle that separates lasting wealth from tragic ruin. You now understand the brutal mathematics of leverage, the psychological traps that lure even the brightest minds into its grasp, and the profound power that comes from simply staying in the game. This knowledge is a firewall for your financial future. You now possess the blueprint to build a fortress, to ensure that no market crash, No economic storm, no single bad outcome can ever take you out of the game. You have mastered the art of financial defense. But as any great strategist knows, a perfect defense is only the first half of victory. It is the foundation upon which true dominance is built. Avoiding ruin is the critical first step, but it is not the end of the journey. The next step is to go on the offensive. Warren Buffett did not become one of the wealthiest people in history simply by avoiding mistakes. He did it by combining his impenetrable defense with a brilliant, repeatable, and devastatingly effective offensive strategy for identifying and acquiring wonderful businesses at fair prices. What you have learned today is one crucial pillar in the grand architecture of his thinking, but there are others. There are mental models for evaluating businesses, for understanding competitive moats, for allocating capital, that all interconnect with the principle you have just mastered. The journey to true financial sovereignty is about building that complete arsenal. The video that is now on your screen is the next piece of that map. It is the link that connects your impenetrable defense to a powerful offense. It is the next weapon you need to add to your cognitive toolkit. Many people will stop here. They will feel satisfied with what they have learned and click away. But a select few, those who are truly committed to not just surviving but thriving, will see this as a critical turning point. They will understand that the journey is not complete. The question is, which one are you? If you are ready to move from simply protecting your capital to actively and intelligently compounding it, if you are ready to complete your mental arsenal, then you know what to do. Continue your ascent. Click the video on the screen and acquire the missing link.